Hi, welcome to another MENA market briefing. Today's June 24th, and today I'm going to run you through some key developments in the sanctions space and the impact they've had on the fuel oil market since the Ukraine conflict began in February this year. I'll briefly address some of the key developments in sanctions and how they relate to the Russian fuel oil trade, and then we'll explore the impact on trade flows. We're going to pay close attention to the power sector, particularly in the Middle East and Asia. And we'll also explore some of the implications for the high sulfur fuel oil market going forwards. So stay with us. Okay, so here we have a high-level summary of the sanctions that are targeting Russian individuals, Russian companies, and government entities. Presumably these are designed to inhibit government revenues that may be used to fund military operations. Now, with respect to the oil markets, arguably the most significant of these sanctions tools include the exclusions from the SWIFT payments system, sanctions against Russian banks and oil companies, as well as import bans, oil import bans in key states. So inevitably, this actually prohibits the purchase of oil in many cases, but it also more generally impedes trade finance and creates complications for shipping operations. If we look at the countries across the top there, we've got United States, European Union, UK to a lesser extent, among others. But those that I mentioned, they're key importers of oil overall and have been major buyers of Russian oil over the last few years. So I think the most significant development recently certainly is the sixth round of sanctions we've seen from the EU, and there's a couple of excerpts from the legislation for you here. So critical to know that under these rules, by December 25th, European states need to stop importing crude oil, and by February 2023, they need to stop importing refined products, including fuel oil, of course. So what does this mean for the physical fuel oil trade? Well, existing term contracts can be honored. Those are the ones predating June 4th. No new term contracts may be signed. And short-term spot supply and purchases, that may actually continue going forwards up until deadline day. And in the case of fuel, that's February 5th next year. There are some notable exemptions, of course. Those members receiving crude via the Druzhba pipeline may continue to do so, although Poland and Germany have elected to voluntarily cut those supplies. Bulgaria and Croatia, they're also able to receive VGO and crude oil until later dates. But overall, the impact is expected to see a cut in about 90% of Russian oil exports to Europe by those deadline days. Another thing we need to address, and it's actually critically important, is the imposition or the implication of shipping sanctions, and I've highlighted some of the language here from Article 3M. Now, the US, the UK, EU, obviously, import bans don't prevent third-party countries like India, for example, from importing Russian oil. However, the sanctions targeting the shipping sectors, they're going to be phased in over the next 6 months, and that could actually have global implications. Now, this is because oil cargoes require protection indemnity insurance in order to be shipped. Without that, most charterers won't book a ship, and port authorities won't actually allow vessels into their jurisdiction. An important factor of that is the reinsurance process, whereby the insurance company who issues the contract actually reinsures or shares and pools the risk with other members of a particular club. Now, these so-called P&I clubs, there's not actually very many of them, and the UK and Norway are key players in that. And you have to bear in mind that through UK subsidiaries or through trade agreements Norway has with the EU, they are essentially subject to those sanctions and rules as well. So ultimately, charterers wishing to move a Russian cargo come later this year will actually struggle to get insurance on that cargo. They'll have to find alternative providers. In the past, alternative providers may spring up on a national basis, and sovereign guarantees have also been issued. And it's really important to note that this mechanism, this sanction mechanism, was particularly effective in restraining the trade in Iranian oil under the current sanctions regime. So with that taken into account, Poten Partners, as a shipbroker, has issued some analysis whereby they expect that due to the limitations on tonnage available as a result of these sanctions that I've highlighted here, Russian oil exports overall could fall by as much as 50% at the end of this year when these sanctions come into play. So you could see significant headwinds for Russian trade flows going forwards. So far, Russia's actually managed to maintain about an 80% maintain about 80% of its fuel oil exports if you compare pre-conflict and post-conflict averages. Now we're going to drill down here on the country level to see who has decreased their purchases and who has increased their purchases between the comparison periods. The US has replaced Greece as a top destination, or has been replaced by Greece as the top destination for fuel oil cargoes which load at Russian ports. Netherlands, you can see, actually still remains a key transit point. European end users, including Spain and Italy, they have slipped down the rankings. And so have critical transit points, including Denmark and Malta. Meanwhile, on the right-hand side there, we see who's moving up the rankings, and you've got to look to the Middle East in terms of UAE, Egypt, and Saudi Arabia, who are all increasing their offtake volumes. Slight increases from key importers in Asia, namely Malaysia, and to a lesser extent, Singapore. The general pattern that we're seeing is that European refiners and traders are backing off Russian cargoes. The US has stopped buying altogether now, and as a result, those cargoes are having to move east of Suez to Middle East and Asia in search of alternative buyers. And that's offering some significant price advantages for those members willing to take them. As we can see here, Greece is the notable exception to that rule, and we're going to take a closer look at that now. So, Kalamata, Greece, has emerged as a prominent STS location for Russian cargoes, which are being blended and transshipped east of Suez. Now, the data shows major increases in discharge volumes since the Ukraine conflict began, and we've split out those volumes here between Russian and non-Russian supplies. Much of the displaced imports from around Europe and the US seem to be actually flowing to this location at the moment. And then if you look at the load rate, you can also see this is in line with the discharge rate. Now that's significant because all that means is that this isn't a storage location. This is just a transshipment location, and those cargoes are moving quite quickly onto another destination. If we look at those destinations in the bottom chart here, we can see that Middle East, South Asia, and Southeast Asia have been, they've quite significantly increased their offtake since the conflict began in February. The Mediterranean, it's maintaining a market share, as possibly as a result of North Africa, as well as non-Russian cargoes moving in and out of the zone. So if we consider why Kalamata has emerged as such a significant location, one of the reasons is obviously that Greek shipping companies, they control a lot of the tonnage that's available. So they provide these vessels, and they're still perfectly able to do so. And some of the things that you require as a ship operator or a charterer in order to conduct an STS transfer is, first of all, a dedicated STS zone where you can actually conduct these operations. Bunker availability can be an important factor. And then as well as offshore services, such as mooring and maneuvering. Vessels are required to assist with these operations. And then also professional mariners. We have specialist pilots that come in to assist with these operations. So Kalamata obviously has these in abundance at that location. It's why it's quite a popular STS point within the region. It's also strategically or geographically located in such a way that is one of the most efficient ways of moving Russian oil from the Baltic, from the Black Sea, co-loading, and then onward shipping east of Suez. So what we do need to remind ourselves here is that, in fact, Greece is, of course, a member of the European Union, and therefore, how sustainable are these operations as a result of the new sanctions that are coming into place? I'd have to say, I think we're probably seeing the expiration date on this trade flow coming towards us quite quickly. And in fact, already STS activity at Kalamata does appear to be winding down. You can see that in the top chart in the June volumes. And in actual fact, if we look down on a weekly basis, I don't have the data here, but the weekly data shows that there's a significant drop off in the last few weeks towards the end of June, suggesting that political pressure is starting to bite into this activity. So where might you go instead if STS in Kalamata is no longer an option? Well, conducting those operations in European water is going to be difficult. And the alternative locations may include Cyprus, potentially North Africa, around Egypt, maybe another example. So we'll have to see how those trends play out over the coming months. But either way, you're kind of looking at a final destination of the Middle East and Asia, because these seem like the most likely candidates to continue buying Russian fuel oil on an ongoing basis. And we'll take a closer look at that now. Okay, so after Russia and possibly Mexico, Middle East countries are the major alternative high sulfur exporters and suppliers. And we're already seeing Western buyers, particularly the US, come in for cargoes following the import ban in the United States. We can see this represented in the regional export data here. So if we try and highlight that for you very quickly, this block represents US buying in March, continued in April, and it does soften slightly into May. We've got Mediterranean and dark grey here as well. There's a good possibility that those are onward transfers to the US via potentially Gibraltar or Malta. Now the chart on the right there, that shows, or shows the spread between Middle East spot prices and Singapore spot prices. And what you can see, that's the spread. So the dark grey line is the Singapore price premium relative to AG cargoes. And the blue line is the price of an Aframax from the AG to Singapore. And what you can see, there's very, very close correlation, which indicates, therefore, that AG spot prices are more or less a freight netback of Singapore fuel prices. So it's really Singapore that we need to look at as the price indicator for the arbitrage of Middle East fuel cargoes west. And as the US buying came or increased through March and April here, the prices on Singapore high sulfur fuel oil increased substantially because there was a massive slowdown in flows to the region, causing a tightness in the market. And I think that in turn obviously widened the arbitrage and made that move of Middle East cargoes to the West unviable. That has now come in, and it looks like that trade could start to pick up again for deliveries in July and August. So as Middle East exports increase, we also observe a simultaneous increase in Russian fuel oil flows or arrivals to the region, and we can see that in the bottom chart here. What we can see here is that these are Russian or Estonian origin cargoes discharging in either Egypt, Saudi Arabia, or the United Arab Emirates. Those are the key offtake points. You want to bear in mind that Egypt, this is Ayn Sokna, which is actually Saudi operated storage. So when we read discharge in Egypt, we should really read Saudi import as well. Okay, so you can see since February, relatively low volumes, and they've ramped up considerably in the last few months. Now, why might that be? Well, we really see that the regional power sector in South Asia and the Middle East are the key drivers for that. And we'll take a slightly closer look at that here. Okay, so we're going to start with the incentive to buy. And high sulfur fuel oil is an important feedstock for power plants in South Asia and the Middle East. And it's an alternative feedstock to gas. Now, gas prices have absolutely rocketed after the last 12 months. And here we have the spread the price spread between LNG in West Coast India and the AG spot price of fuel oil. And what we see here is a very deepening discount on fuel oil relative to LNG, and that provides the price incentive for utilities providers to switch. We can see it's ebbed over the first 6 months of this year, but it still remains at a discount now of around $240 per metric ton on an equivalence basis. So, given the incentive to buy is there, we can actually see that translate into the import numbers at some key offtake points around the region. So if we go to the bottom left chart here, we can see that Pakistan is really ramping up its imports of high sulfur fuel oil in recent months. And this is for May at 461 KT for the month. If we compare that to the year earlier, it was 60 KT. June was 0, and we were already, for last year, 2021, we were already at 200 KT as of 20th of June. So, yeah, I mean, the buying really has started early in Pakistan, and if we look at the previous year, that could really sustain over the next few months. And we definitely see, in terms of weather developments in Pakistan, cooling day demand has already exceeded multi-year highs, and it looks like to continue over the next few months. So that's very bullish for high sulfur fuel demand in Pakistan, and therefore Asia demand and prices. We look at Saudi. Saudi is the other major buyer in the region, and we can see here over the last few months, imports have hit 810, 770, 831 KT per month. Look at that compared to last year. It's not insignificant. So if we turn to the right-hand charts here, I want to see to understand if, in fact, is this trade sustainable? In the case of Saudi Arabia, we see demand is not insignificant. Imports are 891 KT for the month, but overall demand within the power sector is considerably higher, actually closer to 300 KT, that's 3 million metric tons per month. Because here on the bottom chart, we have domestic transfers. Domestic transfers of fuel, 787 KT for the month. This is June, and therefore incomplete. And we've got an even higher number, over 1 million KT, 1 million metric tons of crude transferred into domestic power terminals. So the demand is significant, and you can see it's likely to continue on a seasonal basis, as we saw through the same period last year. So we're really only getting to the start of Saudi fuel demand. And what that means is essentially if demand for Russian fuel could continue over the next few months. Now, we talked about that demand as a case of sustainability. Well, if we see once we get into the shoulder season, which is really October, November, December, Northern Hemisphere winter, we see a significant decline. That's the domestic demand. Also, the imports coming off considerably. That pattern will be mirrored across the Middle East. Pakistan are likely to do the same. When that happens, what does that mean for demand for Russian fuel? Because these nations appear to be emerging as critical buyers. And you have to ask yourself, well, okay, that's likely to decline considerably during that period. Now, obviously, decline in demand means a potential surplus of potential tank build and a decline in high sulfur fuel prices in the latter part of the year. But a lot of that will depend on the supply side and the supply picture. And that, again, depends on how sanctions really impact Russian exports going forward. So if we're to believe or follow guidance from potent partners that the shipping sanctions could result in a 50% decrease in Russian fuel oil exports come the end of this year, that could essentially mean, if you take the fact that average Russian fuel oil exports for the pre-sanctions period around 4.5 million metric tons. That then could drop to 2 million metric tons. The loss of 2 million metric tons is obviously highly supportive of price, but Saudi demand through that period in the winter is considerably lower. I mean, if we look at this month here, we've got 750 KT demand in the corresponding period of 300, so about 1 million metric tons per month. And that could actually potentially account for about half of Russian demand going forwards, if indeed Saudi Arabia were to displace all its domestic demand with Russian fuel. That's probably unlikely to happen. But those are just a few considerations for us going forwards, and we can see how Middle East buying is going to be a key, potentially a key factor for Russia to sustain its exports going forward, as well as obviously the shipping issues as well. So on that note, we'll close the call, and thank you for joining us, and we'll pick up it again next time. Thanks very much for joining us.